Most retirees are shocked the first time they find out that their Social Security is taxable. They'll say something like, wait a minute, I worked for 40 years. I paid into this system for my whole life, and now you're telling me I have to pay taxes on it again? That doesn't seem fair. And you know what? They're right to feel that way. Here's the reality though. Depending on your income, up to 85% of your Social Security benefits can be taxed. Now, let me be clear. It's not that you're paying an 85% tax rate, it's that up to 85% of your benefit gets added to your taxable income. And here's the kicker. Not everyone pays tax on Social Security. Some people pay more, some people pay tax on half, and others pay on nearly all of it. The difference comes down to how your income is structured and how well you've planned ahead. So in today's video, we're going to dive deep. I'll explain why Social Security is taxable, exactly how the IRS does the math, and then I'll show you strategies you can use both before and during retirement to keep more of your benefits in your pocket. And to make it real, I'll share the stories of retirees who were blindsided by Social Security taxes and others who planned ahead and saved thousands. By the end of this video, you'll not only understand the rules, but you'll know what to do about them. So let's jump in. All right, so let's talk about why is Social Security taxable. Believe it or not, when Social Security started back in the 1930s, the benefits weren't taxable at all. You paid into the system with payroll taxes, and in retirement, your check came tax-free. That lasted for decades. But then in the early 1980s, Social Security was running into financial trouble. In 1983, Congress passed reforms that allowed up to 50% of Social Security benefits to be taxed if your income was above certain thresholds. In 1993, Congress raised the maximum again. Now up to 85% of Social Security benefits could be taxed. And here's the part that stings. Those income thresholds set back in 1983 and 1993 have never been adjusted for inflation. Back in the 1980s, if you made $25,000 as a retiree, you were considered pretty well off. Today, that's squarely middle class, but the thresholds are the same. So every year, more and more middle-income retirees get pulled into paying taxes on their Social Security benefits. That's why it feels unfair, because when people first started collecting Social Security, they weren't paying taxes on it. Today, most people are. So what makes Social Security taxable? All right, so how does the IRS actually decide what portion of your Social Security is taxable? It comes down to something called the provisional income. Here's the formula. You start with your adjusted gross income, add any tax-exempt interest, yes, even interest from municipal bonds, then add in half of your Social Security benefits. That is your total provisional income. Now here are the thresholds. If you're single, below $25,000, no tax on your Social Security. If you have between $25,000 to $34,000 of income based on that provisional income formula, then up to 50% of your Social Security is taxable. If you have above $34,000 of income based on that formula, then up to 85% of your Social Security is considered taxable income. Now, if you're married or filing jointly, if it's below $32,000 of income based on that provisional income formula, none of your Social Security is taxable. If it's between $32,000 and $44,000, then up to 50% of your Social Security is taxable. If it's above $44,000, then up to 85% of your Social Security is taxable. So let's look at an example. If I have John, he's a single retiree, age 67. His Social Security benefit is $20,000 a year. His pension is $30,000 a year. So his provisional income is $30,000 from the pension, then half of his Social Security, which is $10,000, totals $40,000. That's above the $34,000 threshold, so up to 85% of John's benefits, $17,000, will be included in taxable income. Now, let's look at a married couple. Paul and Mary, retired, filing jointly, combined Social Security, $40,000, IRA withdrawals, $30,000. Their provisional income is $30,000 from the IRA plus half of their Social Security, which is $20,000. That gives you a total of $50,000 based on the provisional income formula. That's above the $44,000 threshold. So again, 85% of their Social Security benefit, $34,000, is considered taxable income. Notice what happened here. Neither of these examples are wealthy. These are pretty typical retirees. But because of the formula, most of their Social Security ends up taxed. That's the trap people fall into. We call this part of the tax torpedo. Now, here's where it gets really painful. Because of the way the formula works, when you add more income in retirement, maybe from an IRA withdrawal or part-time work, not only does that income get taxed, but it can cause more of your Social Security to become taxable too. This is what's known as the tax torpedo. Let me give you an example. Jim and Carol, retired couple, they are already collecting Social Security and taking IRA withdrawals. They need an extra $1,000 from their IRA to cover a home repair. Simple enough, right? Take out $1,000, pay a little tax, not a big deal, right? But here's what happens. That extra $1,000 of a withdrawal that they just took pushed them over the line where now more of their Social Security becomes taxable. So instead of $1,000 being added to their taxable income, $1,850 was added. Their effective tax rate on their $1,000 of withdrawal was much higher than expected. And it doesn't stop there. Higher taxable income can also push Medicare premiums higher through IRMA charges. So the ripple effect is very real. Social Security taxation isn't just about the tax bill itself. It impacts your retirement budget. So let's talk about some of the strategies before retirement that you can do to help potentially reduce your Social Security being taxable or even your IRMA. So enough of the bad news. Let's talk about what you can do about it. The best time to plan for Social Security taxation is before you start your benefits. Let's go over a few strategies. One, a Roth conversion. One of the most powerful strategies is converting a traditional IRA or 401k money into Roth IRAs before you claim Social Security. Why? Because withdrawals from a Roth IRA don't count towards your provisional income formula that we talked about earlier. So let me tell you about a story about Susan. Susan's retired at 62. Instead of claiming Social Security right away, she started converting chunks of her IRA into Roth accounts. By the time she claimed benefits at age 67, she had a much smaller IRA, a large Roth account, and very little of her Social Security was taxed. The key here is timing. The years between retirement and when you claim Social Security are often your lowest income years. That's the perfect window to do Roth conversions. Now, we could delay Social Security, and that's another strategy you could use besides Roth conversions. Mike and Diane, they decided to wait until age 70 to claim. In the meantime, they lived on IRA withdrawals and taxable accounts and even did some Roth conversions. When they finally claimed their Social Security benefits, not only were their benefits higher, but they had fewer taxable IRA withdrawals. That meant less of their Social Security was going to be taxable. Now, there's some problems with this, potentially, that we also have to look at life expectancy. How long will you live? It's hard to say. And do you want to enjoy your life now rather than, having a bigger Social Security check later? That's where a lot of these strategies have to kind of come into play, not just with the financial side of things, but also with your emotions and your health and everything else. Okay. The other strategy you could look at doing is diversifying income buckets. This is about balance. You don't want all of your retirement savings in traditional IRAs or 401ks. Having money in Roth accounts and taxable brokerage accounts gives you flexibility. Michael, he retired with all three buckets. In some years, he pulled from Roths and others from his brokerage account. By mixing and matching, he kept his provisional income low and reduced his Social Security taxation. One other strategy is harvesting capital gains early. If you're close to retirement but not yet on Social Security, it can make sense to sell investments and realize gains while you're still in a lower tax bracket. That way, once Social Security starts, you're not layering on extra income that makes your benefits taxable. Now, what if you're already retired? Now let's talk about some strategies during retirement. So, just because you're retired, it's not too late. You still have options. Let's talk about managing withdrawals. Don't just default to pulling your income from your IRAs every time you need cash. Think about mixing Roth withdrawals with smaller IRA withdrawals. This can prevent you from crossing thresholds that make more of your Social Security taxable. We could also look at qualified charitable distributions. After age 70 and a half, you can donate directly from your IRA to charity through what's called a qualified charitable distribution, or QCD. The amount you donate doesn't count as income. That lowers your provisional income, which can reduce the amount of Social Security that's taxable. So if you're already giving to charity, this is a tax smart way to do it. There's some tax efficient investments you could look at. Here's one that surprises people. Interest from municipal bond is tax-free federally, but it still counts in the provisional income formula. That means it can make your Social Security taxable. Sometimes you're better off holding dividend stocks or other tax-efficient vehicles instead. One last thing we can look at is spousal planning. And don't forget, when one spouse passes away, the surviving spouse often ends up paying more taxes because they're now found as single. So planning ahead is crucial here. You could do some Roth conversions or strategic withdrawals that can help soften that blow. When we met with Anna, her husband passed away at age 72. Her Social Security stayed the same, but her tax bracket changed. Suddenly, she owed much more in taxes as a single filer. If they had done more Roth conversions earlier, it would have reduced that hit. All right, now there are some misconceptions, so let's clear up a few common myths. Social Security is double tax. Technically, not really. Payroll taxes fund the program, but income tax on benefits is based on current income. It feels unfair, but it's not the same dollar being taxed twice. Other misconception, rich people don't pay taxes on Social Security. Actually, high-income retirees almost always pay tax on 85% of their benefits. One last misconception, there's nothing you can do about it, which is not true. As you've seen, there are many strategies, it just takes planning. So let's bring it all together. Social Security taxation was introduced in the 1980s and expanded in the 1990s. Because the thresholds haven't moved with inflation, more and more retirees get pulled in every year. The IRS uses the provisional income to decide how much of your benefits are taxed, and up to 85% can be included. The real danger is the tax torpedo, where your income causes more of your Social Security to become taxable, raising your effective tax rate. But with smart planning, Roth conversions, delayed benefits, diversifying income sources, using QCDs, and managing withdrawals, you can often reduce the tax hit. And remember, this isn't about just 1 year. It's about building a strategy for the next 20 or 30 years of retirement. All right, let's go back and talk about all the stories that we went through. John, he was blindsided when most of his benefits were taxed. Jim and Carol learned the hard way with the tax torpedo. But Susan, Mike, and Diane, and Michael all planned ahead, and they kept more money in their pocket. Here's the bottom line. Don't let Social Security taxation catch you off guard. Plan ahead, understand the rules, and make smart moves. Thanks for watching. If you found this video helpful, hit the like button, subscribe for more retirement planning insights, and share this with someone who's close to claiming Social Security benefits. It could save them thousands of dollars. And remember, retirement isn't just about saving money, it's about keeping it. So if you'd like also to learn about what might be best strategies for yourself, you can always set up some time with me as well. We'll leave a link in the description below. Have a good day. See you later.